The one big beautiful bill just passed, and while some of the original proposals were cut, there are still some major changes coming for retirees. In this video, we're going to be doing a side-by-side comparison to show exactly how those changes will impact your taxes. In one case, we'll cover a retiree will end up saving over 50% on their tax bill. Let's dive in. A few weeks ago, we did a deep dive on the original tax proposal, but as often happens in Washington, some of the most ambitious ideas didn't survive the final cut. Now that the one big beautiful bill has officially passed, I'll be doing a full breakdown soon. But in this video, I want to zero in on some provisions that matter most to retirees, especially the changes to tax brackets, standard deductions, and the new senior bonus deduction. The biggest headline, the 2017 tax cuts are no longer sunsetting. We were on track to revert to the old pre-2018 tax code next year. That would have meant tax rates rising by 0 to 4% across the board, plus a major drop in the standard deduction. But with this new tax bill, the current tax system is now permanent, and retirees actually gain access to some new deductions. So in this video, I'm going to show you a direct side-by-side comparison of how these changes play out in real retirement scenarios. But before we jump into these examples, let's get our bearings here. Here's a snapshot of the 2025 tax brackets, and you'll notice there's no real changes in the bracket levels or rates. Really, most of the change comes in 2026, and they aren't a change from the current rates, but rather what the rates were going to be. So for our comparisons, we'll be looking at 4 different versions, if you will. 2025 under the current rules versus the old rules, and then what 2026 would have looked like under the old law and what 2026 now looks like under the new law. Even though the tax rates stay flat in 2025, the bill still introduces a few big changes, mainly around deductions. First, the standard deduction is increasing. Single filers get an extra $750 for the year. Married couples get $1,500 more. And here's the big one, the new senior bonus deduction. If you're over 65 or legally blind, you qualify for an additional $6,000 per person. That's up to $12,000 in this extra senior bonus deduction for married couples. Now, we'll get into some key details about this bonus later, but first, a quick refresher. A deduction lowers your taxable income. If you get a $1,000 deduction and you're in the 22% bracket, that saves you $220 in taxes. A credit, on the other hand, reduces your tax bill dollar for dollar. These changes that we're discussing all are deductions, not credits. Let's start with our first direct comparison. This example features a 62-year-old retiree filing single. They're in the early years of retirement and looking to execute relatively large Roth conversions now to reduce future taxes, especially once RMDs or required minimum distributions kick in. On the screen, you'll see the key components of their taxable income for this year. A modest $10,000 pension, $27,500 in long-term capital gains from selling investments in their taxable account, which they're going to be using to fund their lifestyle, and a sizable Roth conversion with the goal of maxing out the 24% tax bracket. Now, on the left side of the table, you'll see what their 2025 tax situation would have looked like before the new bill passed. On the right, we've updated it to reflect the current law. At first glance, not a lot has changed. But as we look a bit closer, underneath the new law, this retiree can convert $750 more to their Roth IRA while keeping the exact same tax bill. Now, this certainly isn't anything to write home about, but does provide a little bit extra juice that one can squeeze from the last dollars into their Roth at a slightly more efficient rate. So what's the main difference behind this? You've probably already guessed it, the increase in the standard deduction. For single filers, again, it rises by $750 for a total of $15,750. So for 2025, the change is certainly small, but still beneficial. What about 2026? Let's run the exact same scenario forward a year. We're going to assume 2% inflation adjustments here to the tax brackets. The pension and long-term capital gains here stay the same, and we're still focusing on maxing the 24% bracket underneath the new law. The Roth conversion amount we're using here is a bit over $207,000, which lands right at the top of what the 2026 24% bracket would be. Now, here's where things get interesting. What would the exact same income have looked like underneath the old tax law had the Tax Cuts and Jobs Act expired as scheduled? Well, under the old system, the 24% bracket becomes 28%. The 22% bracket becomes 25%, and the 12% bracket becomes 15%. So nearly every chunk of this retiree's income would be taxed at a higher rate. In this case, underneath the new law, total tax, $46,000. Underneath the old law, total tax, $53,000. That's a 15% increase in the total tax liability, $7,000 more for making the same financial moves a year later, but under different rules. The increased standard deduction certainly helps out a little bit here, just like we saw in 2025, but the real driver here for the tax difference is the lower marginal rates across the board. Every dollar of income, whether it's pension, capital gains, or Roth conversions, is now being taxed slightly more favorably. And while you're still dealing with six-figure conversions, those small differences really add up fast. Now, let's move on to a more modest scenario. We're using a married couple here, both over the age of 65, who've already filed for Social Security as of 2025. This couple receives $52,000 in total Social Security benefits, $35,000 in IRA withdrawals to cover living expenses, a small $6,000 annuity fully taxable, and around $5,000 in dividends from a taxable account. That's it. No Roth conversions, no advanced tax strategies, just a fairly straightforward retirement income plan. Instead of showing their adjusted gross income as we did before, we're going to focus on taxable income here. Under the old tax law, their taxable income would have been about $43,000, resulting in about $4,000 in taxes. But under the new tax law, their taxable income drops by $13,500, cutting their total tax bill to just under $2,500. That's a 39% reduction in total taxes owed without changing anything in their income. So what's driving this drop? Since tax brackets haven't changed yet in 2025, the entire difference comes from the deductions. And here's how it breaks down. Under the old law, this couple qualified for about $33,000 in deductions, which included the standard deduction plus the over 65 age-based add-on that's been in place for years. Under the new law, however, the standard deduction increased by $1,500 for married filers. They still get that over 65 add-on that's still here. And most importantly, they now qualify for the new $12,000 senior bonus deduction. Add that up, $1,500 from the increased standard deduction and $12,000 bonus, and you get that $13,500 reduction in taxable income. Exactly the difference we saw in the tax outcome. Now, let's talk about that senior bonus deduction because it comes with some important caveats. First, it's temporary, only available from 2025 through 2028. After that, it disappears unless extended by future legislation. It phases out based on adjusted gross income. Begins phasing out at $75,000 of AGI for a single filer and $150,000 of AGI for married couples. Originally, this phase out was going to be a cliff, lose the whole deduction if you go $1 over. But the final version of the bill uses a gradual phase out, which is much more planning friendly. Now on the screen, you'll see a marginal tax graph showing how additional income affects this couple's tax bill. So on the screen, I have a marginal tax graph that is factoring in all of the income that we've already discussed in this person's situation. So if this couple added another $5,000 of IRA withdrawals on top of what they already have, you would follow this graph to the $5,000 increment mark, and you would see they are paying a marginal tax rate of 22.2% on additional income. Now look at the green section. This is the effect of the senior bonus phase out. Because it's gradual, the phase out adds about 2.6% as a marginal rate during this phase out range. So yes, your tax rate is higher if you're in this zone, but it's certainly not prohibitively expensive if you're forced into this phase out zone for something out of your control. Now let's look at how this couple fares in 2026. For consistency, I've applied a 2% inflation adjustment to the tax brackets, but I've left their Social Security and other income sources unchanged just to isolate out the impact of the tax law changes. Looking at the comparison table on the screen, the difference becomes even more pronounced. Under the old law, their taxable income would have been nearly $46,000, resulting in just under $5,000 in taxes owed. Under the new law, their taxable income drops to just under $29,000, and their tax bill is cut in half to just under $2,500. That's a 51% reduction in taxes without any other change to their income. So what's driving this even wider gap here? By 2026, we're now seeing both factors at play. Larger deductions, the senior bonus and increased standard deduction that we've already discussed. Lower tax rates as well, and wider brackets underneath the new law. Under the old rules, this couple's income would have spilled into the 15% tax bracket. But under the new law, their taxable income doesn't even fill the 10% bracket. That structural shift makes a big difference, even for retirees with modest taxable income. Now, before we wrap this up, there's one more deduction worth highlighting, especially for retirees in high cost of living areas, the SALT deduction cap. Under the old law, the SALT, state and local tax deduction, was capped at $10,000 even if you paid much more in state and local taxes. With the new law, that cap is temporarily raised to $40,000, though it does phase out at higher income levels. A quick caveat, this deduction only matters if you itemize. to benefit your total itemized deductions, SALT, mortgage interest, charitable giving, etc., have to exceed the new higher standard deduction. But there is a key nuance here. The senior bonus deduction is separate from this. You can still claim the $6,000 per person on top of itemizing or using the standard deduction. It's not an either or. This creates an interesting planning window. If you're in a high tax state and you've been bumping up against the SALT cap, this bill could offer even greater tax savings, especially if you're already close to itemizing. The bottom line here, unless you're already paying zero in taxes, this new tax law is likely to lower your retirement tax bill, sometimes quite significantly. Whether you're pursuing tax strategy or just drawing steady income, the structure of the new brackets and deductions opens up more room for planning. So as you've seen, this new tax law really reshapes the retirement landscape in a pretty meaningful way, whether you're doing, again, advanced planning like Roth conversions or just drawing that basic income on an ongoing basis. But tax savings alone don't make a strategy right for you. If you're considering things like Roth conversions, now is a great time to revisit that decision underneath the new rules. But keep in mind, they're not always the slam dunk that a lot of people make them out to be. In fact, there are plenty of situations where a Roth conversion could actually backfire and certainly don't make sense. If you want to understand when that might be the case, check out this video right here. 6 reasons Roth conversions might not make sense for your situation. Click here to learn more, and always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next